We all use banks. We trust them with our hard-earned money, expecting it to be safe and accessible. But have you ever stopped to think about how banks actually make their money? And what would happen if everyone all at once decided to take their cash out? It's a fascinating paradox at the heart of our financial systems, and today we're going to break it down. At its core, a bank is a middleman. Think of them as matchmakers for money. They connect people who have extra cash, that's you, the depositor, with people who need to borrow money for a house, a car, or to start a business. The main way they profit is through something called the net interest margin, often just called the spread. When you put your money in your savings account, the bank pays you a small amount of interest, let's say 2%. They then take that same money and lend it out to someone else. When lending money, the bank takes a much higher interest, let's say 5%. The difference between what they pay you and what they charge the borrower is their profit. In this example, it's 3%. They're essentially renting out your money at a higher price than they pay for it. But that's not all. Modern banks have multiple income streams. Every time you use an ATM machine or even swipe your debit or credit card, the bank takes a small percentage. Imagine a situation where there's been a terrible accident and everyone has become afraid of their money. And therefore, you decide that tomorrow you're going to the bank and you're going to get your cash back. Now for the big what if. What if every single customer, the entire town, showed up at the bank at 9 a.m. tomorrow, demanding their cash? Well, the bank would quite literally run out of money. This is due to something called fractional reserve banking. Banks are only required to keep a small fraction, historically around 10% of their total deposits as physical cash in their vaults. The vast majority of your money isn't sitting in a vault with your name on it. It has been lent out. It's tied up in 30-year mortgages, car loans, business expansions, and so on. These are valuable assets for the bank, but they can't be turned into physical cash instantly. So during a bank run, there's a domino effect. As news spread that the bank can't keep demand, more and more people panic and rush to withdraw their money, making the crisis worse. Then the bank quickly exhausts its physical cash. They might be rich on paper, but they lack liquid funds. To get cash quickly, the bank might be forced to sell its long-term assets, like those mortgages or loans, at a massive discount. This fire sale can cause them to lose so much money that their debts outweigh their assets, leading to insolvency and collapse. Then panic increases, and the circle continues. Because a bank run can be catastrophic for an economy, we have crucial safety nets in place. In many countries, like the US, your deposits are insured up to a certain amount. This means that if a bank fails, the government guarantees you'll get your money back. And this is huge for preventing panic, as most people know their money is safe. And central banks, like the Federal Reserve in the US, act as a lender of last resort. If a healthy bank faces a temporary cash shortage due to unexpected withdrawals, the central bank will step in and lend them the emergency funds to ensure they can meet customer demands. So the next time you deposit money or take out a loan, you'll have a better understanding of the intricate balance that keeps our financial system running. Banks thrive on their trust and the assumption that we all won't show up at once. With modern safeguards, a full-blown catastrophic bank run is a rare event. Thanks for watching, and please subscribe.